Most commodity futures traders rely on two distinct methods to map the market. They use technical analysis to read price trends on a chart, or fundamental analysis to measure real-world supply and demand. But both methods often overlook a mechanical constraint built into the market. Futures contracts have strict expiration dates, and since a very small percentage of traders have any intention of taking physical delivery of thousands of tons of grain or barrels of oil, they have to navigate around that expiration. To maintain a perpetual position in the market without taking delivery, a trader has to roll their position forward before the current contract dies. This mechanical requirement creates a hidden third dimension in futures trading. You can perfectly predict the price direction of wheat or crude oil and still lose millions of dollars purely due to the mechanics of the roll. The act of rolling a position requires a simultaneous two-part trade. A participant must sell their expiring, near-term contract while instantly buying the deferred future contract for the next month. However, these two contracts rarely trade at the exact same price. One is almost always trading at a premium or a discount to the other. This price difference is known as the spread. Because traders are forced to bridge this gap to keep their positions alive, the spread dictates a continuous, massive transfer of wealth directly between the buyers, the longs, and the sellers, the shorts. Surviving this wealth transfer depends entirely on identifying which side of the spread you are on and recognizing which of two specific market states you are currently standing in. The first and most common market orientation is contango. This is a state where the nearby contract trades at a discount to the deferred contract in the future. This chart tracks the daily standard spread of canola futures over a 6-month period. The data points mapped below the zero line here represent the near-term contract trading at a clear discount to the deferred contract, illustrating a classic contango relationship. This discount isn't random. It represents an intrinsic property of physical commodities. Taking immediate delivery means taking on immediate costs, specifically paying for the physical silo space to store the grain and paying the interest on the capital tied up in owning it. These storage and interest costs create a hard mathematical ceiling on the spread, known as full carry. If the price gap between the two contracts were to stretch wider than the actual cost of storage and interest, it creates an arbitrage opportunity. Traders would immediately buy the cheap physical commodity, safely store it, and sell the deferred contract to lock in a guaranteed risk-free profit. That automated buying pressure drags the market precisely back in line. For a trader holding a perpetual long position, contango acts as a continuous penalty. To roll forward, they must sell their discounted near-term contract and buy the more expensive deferred contract, steadily increasing their average purchase price with every roll. Wealth is reliably siphoned from the longs to the shorts. But because of the arbitrage mechanism, that loss is strictly capped by the physical reality of carrying costs. The alternative state is backwardation. This is an inverted market where the near-term contract suddenly trades at a premium over the deferred future. This is a spread chart for WTI crude oil futures. Notice the sharp, sudden spike pushing the spread rapidly into positive territory. This inversion into backwardation happened right at the onset of a geopolitical conflict in the Middle East. Backwardation is driven by immediate psychological pressure. The market perceives a severe impending shortage. Buyers become so desperate to guarantee their operations keep running that they will happily forfeit normal storage costs just to secure immediate physical supply. Contango is capped by the real-world cost of silos and interest rates. Backwardation has absolutely no mathematical parameters. It is driven purely by the magnitude of the perceived shortage, meaning the spread can widen endlessly based on panic alone. In this environment, the flow of money violently reverses. The short sellers are heavily penalized, forced to buy back at a premium. Meanwhile, the perpetual longs roll their positions at a profit, decreasing their average cost. An inverted market strips away all physical guardrails. It creates an environment where wealth transfer is fueled entirely by human desperation, with no ceiling to stop it. Futures contracts do not exist independently of one another. The commodities market operates as a highly sensitive closed loop. It is a zero-sum game where the exact dollar value lost by one participant is gained by another. Commercial hedgers have a built-in defense mechanism against these swings. If they lose money rolling a short position in backwardation, they offset that loss by selling their actual physical commodity at the inflated market price. Pure speculators do not have that luxury. They absorb the full impact of the spread directly. Despite this exposure, many traders rely on a completely passive approach. They treat the role as a scheduling chore, waiting until the final orderly liquidation period of a contract to indiscriminately move their positions forward based solely on the calendar. In a zero-sum environment, passive participants become the default funders of the market. By ignoring the orientation of the spread, they silently bleed capital over to the traders actively exploiting the price gap. Mapping price trends and studying supply lines will only get you so far. Traders must actively manage this third dimension of future spreads, because if you do not have a strategy for the role, the spread will inevitably extract a strategy from your capital.